Welcome to our mini course on harvesting tax credits from rental property. I will be your host, Scott Shelley. I am the CEO of Apollo Risk Management and the creator of the Protect and Prosper portal. Within this module, we are going to learn some of the strategies used by the savviest real estate investors on the planet to lower their taxes and increase profitability on their properties. More importantly, we're going to learn how to take that strategy and apply it to normal properties like rental homes, Airbnbs, and office condos to save or recover tens of thousands of dollars in taxes. Millions of Americans own rental properties and Airbnbs throughout the country. Some in the mountains, some on the water, some are running their businesses out of their building. My wife and I happen to have a place in beautiful Franklin, North Carolina. Something we have learned and a great lesson is that just because a property rents and makes money doesn't mean you made money. Managing the taxes improves profitability and cash flow, a key element in making you the money. Another key lesson is that the Internal Revenue Service allows for the reporting of depreciation by two methods, straight line accounting and cost segregated. Understanding how these two ways of accounting work will unlock tens of thousands of dollars in tax credits and benefits to you. So straight line depreciation, which is the standard way that depreciation works, takes a property, removes the value of the land, and divides the value of that improved property, the building, by either 27.5 years for a residential property or 39 years for a commercial property. However, within the code is a nuance that says if your property is a short-term rental, like an Airbnb, it therefore qualifies for depreciation at the commercial schedule, 39 years, rather than the 27.5 years. Straight line depreciation comes with three problems for most real estate investors. Number one, they won't own the building for 27 or 39 years. They're delaying a benefit they'll never be able to take advantage of. Number two, most of the building won't last 27 or 39 years. It'll need new carpet, a new roof, new windows. Again, they're delaying a benefit for an asset of that property that won't last 27 or 39 years. And number three is the time value of money. $40,000 of tax savings today is worth far more value than $2,600 spread out over the next 39 years. What if there were a way to harvest tens of thousands in additional tax benefits from your rental properties? When would you like to know how? How about now? Surprisingly, not a single real estate mogul uses straight line depreciation, but rather use a form of accounting that allows them greater profitability and cash flow on their properties. It is a form of accounting known as cost segregation, and it goes back in the IRS Internal Revenue Code almost 100 years. However, it is no longer limited to the multi-million-dollar properties. Now, real estate investors like Tara and myself can use the same exact strategy Grant Cardone is to get a tax benefit on our little house in Franklin, North Carolina. So what is cost segregated depreciation accounting? But before we get into what it is, let's talk about who's eligible. First, you must owe taxes. We can't save you taxes or get you a tax refund if you don't owe taxes or you haven't paid taxes. Two, you have to purchase the property in the last 7 years if it's residential and 12 years if it's commercial. Number three, We must confirm that the tax benefit that we can harvest out of the property can be used by you. Not every benefit is usable by the owner. Cost-segregated depreciation is the process of using a specific engineering-based study to break down each component of a property and depreciate its assets based on actual life expectancy. Windows don't typically last 39 years. Roofs don't last 39 years. Carpets don't last 39 years. Most components within a property don't last the entire depreciation schedule. And therefore, the IRS has a space in the depreciation and amortization form to input the values of the assets based on their actual life expectancy. So why doesn't your accountant or CPA do this? And the answer is twofold. Number one, the IRS requires that the data be generated from an engineering study of the property, breaking down the components. Most accountants or CPAs are not certified engineers. Number two, accountants and CPAs are not in the business of creating data. They're in the business of taking the data that you provide them and processing it into your tax returns in compliance with the IRS. Which brings us to another key lesson. The easiest and standard way of doing things is rarely the most beneficial way. The most beneficial way is never the easiest way. So let's look at what cost segregation really is. Again, we are engaging an engineering firm to do a study on the property. And what they do is they break down the components of that property. The shell of the property has a 27.5-year lifespan. The roof of the property has a 15-year. The flooring a 10, the electrical a 20, the landscaping a 7, the pool coating a 15, and appliances a 5. And once they've gathered and assembled and broken down and evaluated each component of that property, they provide that data to your CPA to input the green box and take advantage of the tax benefits of depreciated property in its proper lifespan. The firm providing the engineering study and documentation is doing so within the defined guidelines of the IRS and therefore are also responsible for audit defense of their work. This protects the homeowner as well as their accountant or CPA who's doing the taxes for them. Cost segregation is a strategy that provides both short-term and long-term tax benefits. The short-term tax benefits are in the form of immediate tax savings or a recovery from overpayment in the past couple years. A residential house of $345,000 can see an estimated tax savings of $18,000. A seasonal rental on the ocean might see an estimated tax savings of $46,000. And an office condo worth $1.1 million may see an estimated tax savings of over $67,000. This tax savings represents an immediate improvement in cash flow and profitability for the owner. The long-term benefits are being able to segregate out the assets individually and account for them as you replace them. As you can see, over the course of several years, we have a roof replacement, refrigerator, landscaping, flooring, and a kitchen. In this scenario, we removed $87,000 in assets from the home during those remodels. This eliminated from recapture tax $22,000 in tax savings in the future when we sell the property. What people don't realize is that you cannot be taxed recapture tax if the asset no longer exists in service when you sell the property. But in order to capitalize on that benefit, you have to have a proper accounting of what assets were taken out of service and when. With that being said, the last lesson of this module is that just because a tax credit is available doesn't mean you can use it. Apollo Risk Management and our affiliates are fiduciary advisors and will not take on a project unless our feasibility shows that a meaningful benefit will be achieved by the client. If you meet the eligibility requirements and would like to see the tax benefit potential of your property, complete our feasibility worksheet and our team will go about analyzing the tax benefit opportunity within your property this week. This concludes our module. We hope you enjoyed the content. If you have any questions regarding cost segregation or tax harvesting opportunities from your property, reach out to our team.